Hi, you're listening to Stefan Livera Podcast. Today, for episode 258, my guest is Rafael Schultze Kraft, and he is rejoining me. He is the CTO of Glassnode, and we're going to talk a little bit about some of the on-chain analytics that he and his team have been doing, as well as the supply crunch that's been coming in the Bitcoin world. Because while obviously the price is pumping, you can also look beneath the scenes and see what's going on in terms of how much of the supply is liquid, how much of that is illiquid, what is the behavior going on. So a very bullish episode for you. Now, a message for the sponsors of the show. Lend at HODL HODL is a non-custodial Bitcoin-backed lending platform, so you can lend and borrow globally and anonymously. So if you have stablecoins, don't leave that lying around. Lend it and earn attractive returns. HODL HODL's lending allows you to earn 25% APR on average, which is one of the highest returns on the market. Also, there is no need to sell your Bitcoins even if you are short of funds. This is a way to get some fiat stablecoin liquidity without the need to trust your money to any one party. On Lend at HODL HODL, your Bitcoin collateral always remains locked in escrow. Lend at HODL HODL is a Bitcoin DeFi, allowing peer-to-peer lending and borrowing directly between its users. With HODL HODL's Lend platform, you set your own terms and put up offers depending on how long you want to borrow or lend and what interest you're looking to earn. Go and check it out, lend.hodlhodl.com. CipherSafe.io are producing the Cipher Wheel product. So if you have invested in a Bitcoin hardware wallet, don't just rely on that piece of paper. Make sure you are using a metal backup seed so that your seed is fireproof, waterproof, rustproof, petproof, and tamper evident. The Cipher Wheel comes in a wheel shape, and you get some tiles. You slide in 4 tiles for each word, and that's how you can back up your seed and make sure that you or your loved ones have access to your Bitcoins if an accident occurs. Go and order yours at CipherSafe.io and make sure you use the code Livera to get 10% off. Compass is an online marketplace which makes it easier for everyone to mine Bitcoin and enhance the Bitcoin network's security. This is the anti-cloud mining option. Compass helps you buy your own ASIC and secure hosting at great facilities around the world. For years, we have all heard that mining is only profitable if you're investing tons of money, but now, with Compass, everyone is able to tap into economies of scale and access reasonably priced hardware and cheap industrial power rates. And if you're unsure about how to get started with mining Bitcoin, Compass offers hardware and hosting bundles, which eliminates the need for advanced technical knowledge and allows you to quickly get started mining Bitcoin with hardware you own. Visit them at compassmining.io and start mining Bitcoin today. On to the show. Rafael, welcome back to the show.
Thanks for having me back, Stefan. Pleasure to be here.
Yeah, so it's been a little while since we last spoke on the show, and there's obviously been a lot going on in Bitcoin, and of course we are here to talk about what's going on chain. So I guess first, before we get into all of that, can you maybe give us a little bit of an update? What's going on with Glassnode since we last spoke?
Yeah, I mean, it's been it's been a wild and an exciting time, right? I think for all of us that have been building throughout the bear market, essentially, we were hoping for this to happen, and we wanted to be ready for the when the bull market starts, and here we are. We were, and it's been wild. There is a lot of a lot of engagement, a lot of requests. Finally, people getting much more into on-chain data as well. It's super exciting to actually now see that data in a bull market in real time. Before it was always only in retrospect with respect to what happened in 2017. So yeah, we're doing very well. Very exciting times.
Yeah, and you guys have been sharing a lot of great updates. Now, let me just maybe take a step back, just for any listeners who are new, just to kind of explain a little bit about what's going on here. Are you able to maybe just give a little bit of an overview? How does, all this Glassnode on-chain analytics stuff work? If you could just explain a little bit around kind of the basics of how you're able to see what's going on chain, just for that listener who is new, they're trying to learn about Bitcoin.
Yes, of course. So on-chain data obviously refers to the data that is recorded on the blockchain, the transactional data, right? So when people interact with a network, with the Bitcoin network, what they essentially do is sign transactions, send them in the network. Miners pick those up and create new blocks that get mined, and that data essentially gets saved on the blockchain. And so this transactional data really has a lot of information, right? And that's something that is unprecedented, because things like that don't exist in traditional markets. And so this gives this whole Bitcoin economy a completely different and new way to actually look at it, look at the data, gauge the market, understand, things like network health, network activity, adoption, investor behavior. What are the hodlers doing? What are the miners doing? How many funds are being moved around, in what sizes, how much is on exchanges, and all of that, right, gives you just this huge amount of possibilities to really dig into this raw data, extract it, and then really create that, or get that information out of it in order to understand what's going on, in order to make better informed investment decisions as well.
Yep. And so then perhaps the next level of detail is something like understanding how, because when somebody's new to Bitcoin, they might think, oh, it's totally private or it's all totally public. And the truth is it's somewhere in the middle, depending on what kind of behavior you use. And if you act, for example, if you use, Samurai Wallet and Join Market and so on, your behavior is a little bit more masked, obviously. But for most users, that behavior is visible on chain, and there are certain heuristics, right? Most famously or commonly is the common input ownership heuristic. So for listeners out there, when you spend your Bitcoin, it's like, think of it like you're casting down a bar of gold and recasting it into a new size of gold. And then based on the way those move around, people can try to essentially cluster different balances and then try to track different users on the chain. Would you say that's a fair summary of, in some sense, what you're doing?
Yeah, roughly. So the basic unit on the blockchain is an unspent transaction output, right? And that holds some amount of Bitcoin. And so if you own Bitcoin, what that means is that you have a private key that is associated with the address that is related to that Bitcoin, right? And it gives you the right to actually spend it, right? And so when you do that, that UTXO essentially gets destroyed, gets spent, right? And a new one gets created. And a transaction can contain many of these inputs, of these UTXOs that get spent together. And essentially, when they get spent, they essentially get destroyed. New ones get created as the outputs of that transaction. And so one of those heuristics that you mentioned is exactly that, right? If they get spent together, then you assume that they are controlled by the same entity. Obviously, this is not always the case. There's a lot of nuances to that, but in general, this is one of those that is being used quite a lot. And so yeah, Bitcoin in that sense it's not anonymous, right? It's pseudonymous because you can essentially see the behavior of addresses on chain and try through statistical pattern recognition, through machine learning, through clustering, and many advanced methods, try to gauge which of those actually belong together, which are probabilistically controlled by the same entity. And these are some of the things that we do, but we don't go down to the individual level, right? Because we're not interested in single transactions. I'm not interested in knowing what a particular person is sending to exchanges or so. What we are interested is really the macro view. What are funds? How are funds from a macro perspective moving in the network, and what does that mean for the network and for the market?
Right, yeah, and we might get into how you sort of cluster specific individuals, or not individuals, but rather types of entities like whales and dolphins and so on. But I think it's also interesting just to, as you mentioned, look at the macro level of this. So as we speak today, so today is Wednesday, the 10th of March, 2021, and the price of Bitcoin is around 54,000 USD. And so currently about 18.65 million of the 21 million Bitcoins have been issued or mined into existence, if you will. And so I know some of your statistics look at things like liquid versus illiquid Bitcoin supply. And then there's also, you also consider that some of those Bitcoins have potentially been lost. Are you able to shed some light on those kind of numbers and how you're analyzing that?
Yeah, absolutely. I think that network liquidity is super interesting to look at. So what we do is you can essentially the supply is held by in addresses and is controlled by certain entities, and so you can assess what the probability is of the funds that a certain address is receiving. What is the probability that those are being spent by that entity, and through by quantifying that, you essentially categorize an entity as being illiquid or liquid. And these terms might be a bit confusing. What is really meant here is that entity a strong hodler? So is the probability that that individual or that network participant is going to spend the bitcoins that they received, are they going to spend them or not, versus exactly. So depending on that probability, you classify them as illiquid and non-liquid. And what we've seen essentially that out of those 18.6 million that are already mined today, almost 80% lie with those illiquid entities, right? With strong hodlers, are really in strong hands. So those are Bitcoin that are right not in circulation, or not to the extent that they're constantly circulating, and therefore are available to be bought by someone else. And that is, that is of course a very, very crucial trend, because this essentially leads to this supply squeeze and to this liquidity crisis that we're seeing, which of course points a very, very bullish picture for the price of Bitcoin. And this is a trend that we have been observing now for a couple of months, which that is continuing, and we're not seeing an end to this. So what this essentially means is that the supply that is in constant circulation is around 4 million, right? That is substantially lower than the total amount of mined Bitcoin up to date.
Right. And so just to replay that for listeners, then essentially of the 18.6 million or so, something like 14.5 million of those are actually illiquid. And then really it's only that last kind of 4.2 or so that is actually being liquid and actually being traded around on exchanges. And I think that's a really interesting phenomenon, because I think if you talk to economists and things, they'll say, hey, the price of things is set at the margin. And so even though, it's not like all 18 million Bitcoins are available for supply, are available for sale today. There's only a small fraction of those that are actually traded. And most, and especially in Bitcoin, because we have this culture around hodling and holding your coins.
Yeah, no, exactly. And I think, on those 14.5 million, you can potentially subtract 3 to 4 million that are potentially lost forever, right? That will never come back into circulation. The others are then, with those strong hodlers. So you really see this phenomenon of the one that you mentioned of strong hands, of hodling behavior, something that is not just a meme, but that we see in reality on the network happen.
Yeah. And I think then also, because the blockchain has historical data, this is also another really cool point where I've seen you do some analysis on things like the dynamics over time. And I think you've mentioned that it's like the older hodlers, they tend to sell a little bit as the price runs up. And I guess maybe just thinking through from a fundamental point of view, for some of them, it makes sense. Maybe they want to, maybe they've been waiting for this long and they think, okay, it's time to buy a new house or a new car or something like that. But then really they're holding most of their coins. Is that a similar kind of dynamic to what you're seeing?
Yeah, no, absolutely. I think, and I think it makes total sense, right? I mean, we're still in a fiat-dominated world, and people need to pay bills, and people want to live a good life, and so what you see, this it is this really reoccurring pattern of old coins coming back into circulation once those bull markets really start going up. And yeah, essentially, that's what I think is smart money, right? They are taking profits, they're taking some of the bitcoins to sell. And what we see then, in bear markets is the opposite happening, right? They're sort of, there's this reaccumulation phases afterwards, where potentially those same participants might be actually scooping up, more cheaper bitcoins when it's more cost effective to buy them back in. And yeah, I think that's something that we saw right now as well within the last couple of weeks and months. What is interesting, what I actually looked at just today, and I need to take a closer look, is that if you look at the coins that haven't been moved in more than a year and more than 2 years, those, that percentage of those coins is coming down, right? So, which means, that those coins are actually coming, some of that supply is coming back into circulation. But if you look at the coins that haven't been moved in more than 3 years, that is still going up, right? And those are essentially, the players that have been there before, in 2017, that actually went through the last bull market. And that for me is very, very, very curious to see, right? Because that might actually show that those, investors that have been there, before 2017 and have gone actually through that bull market, have learned from it, and have now stronger hands, and are waiting for even more upside, or even hodling for good.
Yeah, interesting. And I suppose this is always going to be somewhat of an inexact science, and it's about heuristics and trying to get it right on average as opposed to get it right every time. Because I can think of examples where, as an example, let's say somebody is an older hodler, and they are moving their coins, but what if they're moving their coins into a more secure setup? So as an example, maybe they've been sitting on a single signature for a while, but now the value has gone up significantly. Obviously, we're sitting around 54,000 USD. I mean, it was a year ago that we were like 5,000 USD or something. So they might be thinking, well, I need to get my coins into multi-sig and I need to be more secure with my coins. So I guess that's one area where, maybe that cuts against that heuristic a little bit, but maybe on your side, you might be looking at, oh, okay, look at all these coins. They're going into an exchange. So obviously they must be being sold.
Absolutely. I think this is all statistics, right? This is all sort of the overall trend, and there is definitely examples for which these metrics don't hold, and exactly those examples that you mentioned, right? I can totally see someone that having bought a Bitcoin a year ago or so at 5K, and now maybe left it on the exchange or so, and now at 50 50K or 50 plus K, they're thinking to themselves, okay, this is too much, this is too valuable, this is too risky to actually keep leaving it and on an exchange, or are pulling it off to a hardware wallet that they bought or something like this. So that coin that potentially has more than a year since it last moved is now coming back into circulation, but it's nothing that where someone is realizing profits, but really just bull markets draw attention to something that you might have forgotten about, or something that you might not have been paying too much attention to, right? People maybe just want to assure themselves of the accessibility of their coins when the price goes up. There's many things here, I think, that play a role, that do not have always do not have to do with someone selling their coins.
Yeah, there's a lot of interesting aspects around that. And I think it's also worthwhile pointing out here that the coins exist, right? So 18.6 million coins exist. And really what we're talking about is the distribution of those coins changing, because, no matter how many new people come into Bitcoin, there'll never be more than 21 million, right? But it's like, how do you, I guess what we're trying to do here is try to look at what's going on the chain and understand, okay, there's all these new people coming in, and what does that actually look like from an on-chain perspective, right? Because it's not like there's new coins. I mean, other than obviously the block reward, block subsidy, there's not new coins being made. It's about what's the distribution.
Yes, absolutely. So I think, the new coins is the issuance, which currently is 900 a day or so, roughly. That of course is being added on a daily basis, but the bulk, 88% or so have already been mined. So it's all there, right? So it's really looking at that UTXO set of that Bitcoin supply that lives on the blockchain, and then trying to assess what is happening with that, right? How is it being redistributed? What is happening to altcoins? What is, what are the exchanges? All these kind of things that you can actually gawk from looking at that transactional data, which is, as you say, whatever has already been issued.
Yeah. And I'm also curious as well, the impact of, okay, so there's address reuse. And I think in the earlier days, that was more of a common phenomenon where people might just have in their forum, signature or online, they might say, hey, you can donate to me at this address, or you can give me Bitcoins at this address. And then over the years, more and more people are using what's called HD, hierarchical deterministic wallets, where they actually generate a new address to receive into. And so has that changed the analysis for you, or are you still mostly relying on common input ownership heuristic there?
So the common input heuristic is for when you spend them, right? When you receive them, there's different things to this. So first, we have this metric that we call accumulation addresses. That is actually all the addresses that have never spent funds but have received at least 2 transactions, right? And we use 2 because if you use 1, then there's a lot of these relay transactions on chain, right? Sometimes when someone is sending a Bitcoin from A to C, then it goes through an intermediary address for whatever reasons that is very short-lived, and then it actually is just a one-time use disposable address. And that's why we look at those that have received at least 2 transactions, and we see that the quantity of these addresses is still growing, right? There is, I think, 500,000 of those that hold almost 3 million Bitcoin. So it's substantial. It's quite a lot. But of course, you're right. There's these dynamics that we've seen as well, where wallets are more sophisticated with respect to which I think is needed, is an important with respect to security and with respect to privacy, and that holds for things like change addresses, right? If I send Bitcoin and I need to spend a certain amount of UTXOs and I receive change from that transaction, nowadays I think it's very, very uncommon that change goes into the sending address, back into the sending address, even though it still exists to a large extent. Like, you wouldn't believe it's still there, right? But more and more wallets actually make use of creating a new one in which those Bitcoin flow back in, and there are other heuristics where you can, with a certain probability, detect those, right? That's it's simple statistical pattern recognition. It's so the methodologies, they need to become a bit more sophisticated in order to maintain the same level of accuracy with respect to these metrics.
Yeah, it's really fascinating stuff. And I suppose one angle that does kind of come to my mind, and maybe this is, the influence of my friend Matt Odell and the privacy angle. I'm curious, does that play on your mind that, some of these heuristics, they kind of cut against people's privacy, and that some of these, clustering algorithms to some extent. Now, I understand you're not doing it to the same level that, say, a chain surveillance company might be doing it. But does that play on your mind in terms of cutting against some of the privacy heuristics of just everyday Bitcoin users out there?
It does, absolutely, and that's something that we've been thinking about a lot as well, right? I think, and this is why I always try to emphasize it and why I try to mention it that we are interested in macro flows and not in individuals. We're interested in those driving forces of the markets. That is the big institutions, and so that's absolutely an angle where we try to be as careful as possible, and then not go down the forensics road, right? Not go down the this particular transaction belongs to X or Y, or comes from a dark market, or whatever that is. So I think this is for us. That's something that's very important to emphasize, because we're really interested in the macro view of what is happening on chain related to the markets mostly.
I see. So if I could press on that thread just once more, it could be that, I mean, in order to find that macro view, you kind of have to cluster somebody's wallet, don't you? I mean, in order to know, oh, see, that's the darknet market, or this is the Hydra market Bitcoins, or this is some, these individuals are using CoinJoin as an example. And then you might have to sort of, to some extent, apply clustering or apply some analysis to that, right?
Yeah, so the only entities that we look at are miners, exchanges, and OTC desks, maybe custodials, right? So I don't even know about the dark markets, and so I'm just mentioning them because I know that there's companies that do these forensic analyses, and that might say this Bitcoin is tainted, or whatever it is, and so these heuristics that we apply, we just apply them automatically in the background through the clustering algorithms, without us knowing like whose addresses those actually belong to, or where those reside, or what whatever that is. The only ones that we actually have labels for are, I mean, obviously the miners. You get them because those come from the CoinMints transactions, and the exchanges, because those are the interesting ones when you're looking at market behavior.
Sure, and I think I think that's fair, and as you mentioned, you're not going to that same level of a chain surveillance company, and I think the answer as well, to be fair to you and other people doing this kind of work, is that really for people who are more concerned, the answer is not to kind of shout at the people doing analytics, but it's to actually be more private on chain, and that means learning to use CoinJoin, learning to use these techniques for your own privacy. If that's what, if you as a listener, that's what you're interested in, make sure you're doing some research into those privacy techniques, and you're using non-KYC methods of acquiring your Bitcoins. But certainly I think the overall analysis is quite valuable and very interesting for those of us who are interested in the macro perspective of what's going on chain, and how many people are hodling and so on. I've seen you chat about some of these different metrics. There's one called NUPL, net unrealized profit and loss. So Rafael, what is that?
So the NUPL is a metric that essentially tells you the percentage of the market cap that is in profit or loss, right? This is a metric that relies on a concept that is the realized cap, and the realized cap is essentially valuing each Bitcoin at the time that those Bitcoin last moved, right? So as compared to the market cap, where you say these are all Bitcoins, this is the supply. Each of those is multiplied by the current price. For realized cap, you do it by the price at which the Bitcoins last moved. And so, taking these two concepts, you can actually quantify how much of the market cap, what is the percentage that is in profit or loss, and UPL essentially gives you exactly that metric, right? So what happens is that the metric then goes up in bull markets when essentially investors are realizing their profits at a lower rate than the market cap is going up, right? And so currently we're, I think, at as far as I remember the last number, which actually essentially means that 700 billion of the market cap are with respect to this on-chain analysis in a state of profit. And this can, you can map this then to essentially these different investor sentiment bands within cycles. And, as you go above 75, 80, this is, when sort of like the market gets very, very greedy because no one's realizing prices. Everyone's, like really, hoping for more and more and more. And this is, where historically it has been a very good indicator for those tops.
Yeah, I see. So it's sort of like it's like a local top indicator, kind of. I mean, obviously these are all heuristics. None of it is like 100%, but historically it seems to be that way, correct?
Yeah, I mean, I use it more for global tops. I think it has been a very good global top predictor. These biggest Bitcoin cycles that we've seen, and the bottoms as well. So it's a very, very nice metric that helps navigate these cycles and actually give you a good feeling of where we currently are, right? Whether it's a good entry point, whether we are entering or leaving a bull market, whether it's becoming dangerous and we might be hitting one of those tops anytime soon.
Yeah. So as you view NUPL then, where you, as you said, it's about 0.7. So I guess what were, just to give listeners some context, what was like a good accumulation point and what's kind of like we're nearing the top point?
So the accumulation points is essentially when most holdings are underwater, right? So that essentially goes below zero, and then below zero essentially means if you have minus 20%, means that 20% of the market cap is underwater, and so these are globally always very, very good entry points historically. And when it goes above, when we enter essentially 75 is when we entry that euphoria greed zone. So this is where you kind of start might want to start thinking about that a top is somewhere near. So we're currently at 70, but it's there's still a lot of upside. If you look at 2017, for instance, I think we entered that 75 range in early December 2017. So we still had 3 weeks to go. In those three weeks, I think Bitcoin did another, 50-60% or so, right? And so we're still way below that, right? Even if we start entering into 75, we might still have, again, if it looks similar this time, those 50-60%, and depending on the price at that point in time, I think there's still some way to go.
Yeah, so it's like, I guess the other question is, can it sort of stay in that range for some time, and then just over time as new people are coming in, it just kind of stays around that 0.7 range? Or does it kind of have to move?
No, I think it can. I think it absolutely can, right? The question is how long, right? I think at some point it really gets overextended, right? And then as the price goes up and up and up, people will start eventually realizing the profits, and then that of course can cascade, and then it comes back down. But we can stay within that range. I don't know how it was for the previous markets, but as I mentioned, I mean, we were almost a whole month in that range, and usually that's towards the end of those cycles where prices really accelerate again quite a bit. But we were close to it. We were close to entering that 75%. Now we're back at 70. So, until we get back to 75, and then, depending on how long we stay there, I think it's something that I am looking at, but nothing that I'm worried about yet at all.
I see. And of course, as people who were around the last few times, they know that there were 30% drawdowns on the way up. So it could well be that we're just going through a few of those on the way up, right?
It could very well be, absolutely, and I think that's just something to keep a close eye on, right? There are these drawdowns. You can go back 30%, right? And that's why I think that it's never good to just look at a single metric, but you start really getting the whole picture by looking at many of them, right? Because each of them gives you a different perspective. Each of them gives you a different quantification on where we are, what investors are doing, and whether we're really close to something that might indicate a top or not.
I see, yeah. And I've also seen you chatting about this metric called UTXO realized price distribution. So I guess they're a little bit related. Can you outline what is UTXO realized price distribution?
Yeah, they're very much related. It's very much related to realized price actually, right? So the realized price is just the average buy price, so to speak, from an on-chain perspective, because it just gives you the average price at which Bitcoins moved on chain, and what the UTXO price distribution does is simply break that up into a histogram where you have these buckets, and then you see how many Bitcoins moved at 20k, 21k, 22k, and so on and so forth. And this actually gives you a really nice overview of that landscape, on where there is a lot of activity, of a lot of volume, and therefore also potentially a lot of capital inflow. So these usually can form these thresholds of essentially support for the price, because there is a substantial amount of people that have assigned Bitcoin that particular price at that moment, right? And so that's what we recently saw, right? A lot of activity between I think roughly 45 to 48k, which has held very strong now within the last couple of weeks, and people seem to see that as a strong support there.
Greetings, Stefan Levera fans. This is Dread here, and I have some big news to share. Swan Bitcoin's new private client services division is open for business. So last August, MicroStrategy CEO Michael Saylor kicked off the trend of companies buying Bitcoin for their balance sheets. A flood of high-profile investors and companies have joined him. Names like Paul Tudor Jones, BlackRock, Square, and Tesla. Swan Private exists to meet the massive international demand from thousands of companies, family offices, and high net worth investors from all around the globe. If you're thinking of buying between 100,000 and 100 million US dollars worth of Bitcoin over the next year, visit swanbitcoin.com/private. That's swanbitcoin.com/private. Fill out the onboarding form or email the CEO personally, Corey@swanbitcoin.com. That's CORY@swanbitcoin.com. Respect fans and one love.
Check out coinkite.com, the creators of my favorite Bitcoin hardware wallet, the Cold Card, one of the most recommended hardware wallets by Bitcoiners. It has a whole range of features, like the ability to use it air-gapped. You can add your entropy to it as well. You can connect it with popular wallets like Spectre Desktop, Electrum, Sparrow, or Blue Wallet to do air-gapped transactions. I've long been a fan of this wallet. It offers very high security at such a low price point, and it offers PSBT, partially signed Bitcoin transactions, natively. It also works great as part of a multi-signature set. So go and get yours at coinkite.com and use the code Levera for a discount. And finally, Unchained Capital are building Bitcoin native financial services on a foundation of multi-signature. So they've got vaults with multi-signature designed for ultra-secure long-term storage. You hold 2 keys, and Unchained Capital hold the 3rd key, so they can be the 3rd key in that scenario. They also offer a concierge onboarding service where they will ship you some hardware wallets, answer your questions, and deposit $1,000 of Bitcoin in your vault. So if you use the code Levera, you get a discount on that too. Unchained Capital offer an OTC desk, and they also offer business accounts for those of you looking to move your corporate treasury to Bitcoin, where you hold the private keys. Go to unchained-capital to find out more. Back to the show. So, in other words, it's peering into the psychology of those investors who feel like I'm not going to sell unless I'm getting a profit. And that's why if they bought in at 45 or 48, they don't want to sell it for 44, for example. So they are more inclined to hold so long as they have a sufficiently strong hand, right?
Yeah, or for whatever reasons they decided to buy at 45, 46, right? So and a lot of people did, right? That's why there's a lot of on-chain volume, and those are not the ones that are going to sell once the price gets back to those levels, right? Those are the ones that are expecting more upside, and so this is where this capital sort of like concentrated on these regions in the price that we see on chain that then become potentially these support levels.
Yeah. In terms of clustering and seeing what entities are doing on chain, what about miners? What are you able to analyze in terms of mining activity on chain?
Yeah, so miners, of course, are crucial players in the space as well. And one thing that I like to debunk always is the miners are selling out, right? This is something that comes up a lot as well, which is not something that we actually see. There is, again, these periods in time where miners, the funds that they hold, they flow out in larger quantities, and we've seen something like this now in November, December, up to January maybe. Which has flattened out again, so they're back at neutral. They're not moving a lot, or not moving the coins out of their wallets, and potentially took some profits there, but it's nothing that is significant, right? It's not this minor sellouts narrative. It's probably more on the side of their economics and bitcoins that they have to sell for their mining operations, but that that short term sell that as I say was not very significant, has depleted now again, and we're back sort of like to the neutral level. That's what the current status is with miners on chain.
Yeah, so I think the narrative has been that, oh, see, miners have all these operating costs, so they need to be spending down the coins to be able to fund that. But I think now we're starting to see some miners come out and say, well, actually, we're able to get debt financing and use that to fund our operating costs, and therefore keep on hodling, or at least hodl more coins or hodl for longer than we otherwise would have had to, because we were able to get fiat financing.
Yeah, absolutely. I think that's part of that, right? Hodlers are incentivized to hodl as well, and they will, and now they have the possibility to do so to a larger extent, by just using Bitcoin lending services or so, and I think it makes a lot of sense for them, right? I think that is part of the narrative. That's nothing that we can see from on-chain data, but from from conversations that we're having, I think that's one of the paths that they're taking at this point.
Yeah, another interesting phenomenon is obviously the collateralized loans space is growing rapidly. Now, disclosure for my listeners, Unchained Capital and Hodl Hodl are sponsors of mine who offer this as a service, but I think it is an interesting phenomenon here, and I wonder, now maybe this is a little bit not as much on-chain analysis, but it's a little bit more just kind of fundamental analysis, or just looking at what's going on in the market. I wonder whether that also contributes a lot more to the, hodling and the restriction of the available supply, because there may be, whether that's an older hodler who wants to, get for living expenses, or it's a miner who wants to be able to hold longer. What kind of dynamic do you think that brings to the Bitcoin world over these coming years?
I think that's something that I never looked into it until actually only recently, and that I find very fascinating what is happening in that space, and how much traction that has actually gotten, like how much has happened on that, right? That's really one of those manifestations that I'm seeing, where this new economy is being built on top of Bitcoin, right? Because now you have, these debt lending, borrowing services on top of this new economy. So I find this very interesting. And the reason that I do, especially, is one, with respect, to miners or everyone wanting access to fiat, without wanting to sell their bitcoins. I think that's a very clear narrative there. And the second one is, especially, when it comes to the markets as well, is that, those are over collateralized loans, for which you get, 6+%. And that is something that you won't find in traditional markets. So what I'm thinking, right, and what I believe is that I cannot imagine anyone, in Wall Street or in traditional finance anywhere to, just look at that and ignore it. And I think that, this could be driving a lot of new capital inflows if people, can actually rely on a, 6%, 7%, 8% yield a year. That's an APY that's not easy to find somewhere else. That I find very, very fascinating. I'm very curious to see how that plays out now in the upcoming months.
Yeah, right. And I see it like, so for example, in the case of someone like HODL, they are actually finding APYs even higher than that. But we should consider, though, that they are doing it's stablecoin lending. So the interest paid on that kind of example is interest on, say, USDT. Whereas in the case of, let's say, you are borrowing against your Bitcoin, you're paying the interest in that example. But I think to the broader point around helping people hodl for longer using these loans, that's an important dynamic. But also on the downside, there is a double-edged sword here, because if there's downwards price movement, then we can see a lot of liquidation. So that's where also listeners have to be responsible and prudent, because if they enter into a loan where they are not having enough coverage for that, then the margin call can come and you can get liquidated. And obviously that's a risk for people. And then that can also bring the price down quite rapidly as well. So it kind of is a double-edged sword in that way.
Yeah, absolutely. I think, and it's still something that is very nascent, although many of these lending services were alive before the Black Thursday event last year, and I think at least from what I know, many of them did a good job of getting through that crisis. Yeah, it's definitely something I'm very curious about, and I'll be having it looking at very closely to see how that plays out in the upcoming months, especially given that the AUMs of these services within the last year have really exploded. So I think that there's quite some activity happening there.
Yeah. Also, in terms of looking at behavior on chain, one other metric I've seen Glassnode mention in some of the weekly analysis is supply adjusted coin days destroyed. So this is a way of looking at older coins moving, correct? What is supply adjusted coin days destroyed?
Yeah, so coin is destroyed is simply looking at the age and the volume of the coins that are moving today on chain, right? So if there's a Bitcoin that moves today that last moved 7 days ago, then that's 7 coin days destroyed, right? If I have 2 Bitcoins that are moving today and the last time those moved was 30 days ago, then that's 60 coin days destroyed, right? So it gives you a metric of about the age and the volume of the coins that are moving on chain today. Supply adjusted here simply means that as time goes by, as there is more supply, then the baseline goes up for coin days being destroyed because there's simply more coins and there's simply more days. So it simply slightly trends up. And so by just dividing it by the supply, you kind of bring it down to the same baseline historically to make it more stationary. And so yeah, coin days destroyed is a super valuable metric. Also, in order to gauge what our long-term holder are doing, right? Our old coins that have been dormant for many months, for many years, coming back into circulation.
Yeah, really fascinating stuff. And I think it kind of, that is probably another one that comes into, if you think through fundamentally, what are some of these people doing? Well, it might be an older hodler who is taking some out, or they need some for living expenses because they've still been hodling and so on. But very interesting in the way that you can perhaps look at some of these and maybe combine some of the different pieces together to give yourself a bit of a more accurate view, or at least try to validate a thesis that you might be having about what's going on in the market. So that's certainly an interesting thing there. I think also the other really big one that a lot of people are talking about now is how the number of coins on exchanges is dropping very quickly. So can you give us your analysis on this? What's the story there?
Yeah, I think that ties into this liquidity supply crisis that we're seeing, right? So what we've observed is that we're seeing this huge depletion of liquidity on exchanges that has now extended roughly a year, I would say. So it's very, very long, very, very deep. I think exchanges have lost around 20% of their supply. And it's an interesting phenomenon because it hasn't happened to this extent quite in previous years. And I think that it's something that fits in very, very well with the institutionalist narrative, right? Because institutionals coming into the space, they're not buying these huge amounts on spot exchanges, right? So they do custodial services, OTC trades, and these kind of things. So I think that this has very much to do with that as well. Potentially also things like lending services, right? That we're talking about that, that being moved there. And then, of course, also, simple education and self-custody, people having, long-term conviction, pulling their coins from exchanges into hardware wallets or cold storage. So yeah, there's the supply squeeze, and I think that's very related to the price action that we've seen recently.
Yeah, and so to give some context on the numbers, maybe you probably have a better grasp on this than I do, but it seems that it's gone from something like 3 million Bitcoins on the exchanges collectively, and it's down to maybe 2.5, and it's still kind of falling a little bit further, like 2.4 million or so.
Yeah, exactly. It's roughly from the peak. I think it's roughly 600K or so since the peak, which from exactly from 3 million, it's roughly 20%, and that's substantial, right? That is very substantial, given that these exchanges are where actually the markets are happening. So it's super interesting what is happening there.
Right, because if we consider that the price is set on the margin, then it means the only way this resolves is if the price goes a lot higher, because anytime some big company or some billionaire or some 100 millionaire or just a lot of retail individuals are out there trying to buy Bitcoin and pull it to their own cold storage, then it means on the exchange side, or on the OTC broker side, they're trying to get out there and source some coins, but there's just not that many left to sell.
Yeah, no, exactly. I mean, even the OTC desks, they need to pull their liquidity from somewhere, right? I think we're actually currently deep diving a bit more into this into this analysis to really get a better grasp of what is going on. There's some unpublished data where we do look at OTC desks where we have seen their balances going up in the same period of time. I think a lot of that is actually moving into custodial services for institutionals, and that's exactly that. It's this liquidity depletion. It's not retail, that FOMO retail kind of dynamic that we saw in 2017, but this fits very, very nicely with all the announcements that we've heard over the last couple of weeks and months of public companies coming in and scooping up those Bitcoins. And those are only the public ones. How many funds and family offices and so on are out there doing similar things?
Yeah, because in 2017, it really seems that it was much more of a retail-driven market. And at that time, the whole institutional money was more of a meme at that point. And it seems that this time in 2021, it really is a lot more institutions who are coming in. And I guess the typical pattern for them is they might be buying on some OTC desk or one of the big exchanges, and then they might be pulling it out into one of the larger custodians. So we're talking, Fidelity as a custodian, Coinbase custody, BitGo, Anchorage, maybe Knox custody, these other players. So essentially, even though the amount on exchanges is dropping, it could still be with a custodian, but just a non-exchange custodian.
Yeah, exactly. And I think that's a large part of the narrative. And non-exchange custodians.
Right, because historically, I think the space wasn't as developed, so a lot more people might have left their coins on an exchange.
Exactly, not at all in 2017, right? I think that's what is actually making this whole institutional capital inflow possible. The infrastructure now in 2020 and 2021 is there. That infrastructure didn't exist to that extent in 2017, right? I mean, there's other factors, but that's now like the accessibility for them, the infrastructure that they need in order to really go deep into this market that didn't exist before. And so yeah, I think that's one of the very big differences between these markets, that in 2017 it was clearly retail focused and retail driven, while now at least that first push of this market was institutionals, and we have only recently seen that retail has actually arrived within the last couple of weeks.
Right. So up until now, it's been mostly institution-led, and if anything now, retail is also coming into the game. So now it's just going to be retail and institutions all trying to stack over the next few months as we kind of approach, as this bull market develops.
Yeah, exactly. I think I don't know when we started seeing in retail. I think maybe a month ago, 6 weeks ago or so, right, where it started slowly coming in. I think there's a lot of off-chain data that shows us as well, right, with respect to sign-ups and sign-ins on exchanges, these website visits, but then also on-chain, you kind of see the amount of new entities entering the space, and that has just like surged crazy in the last couple of weeks. So that's those are the smaller players that are coming in. So I'm really curious to see how this plays out, and how that changes the market and then the volatility potentially as well within the next couple of weeks and months.
I'm curious as well because just, individuals, some of them can be weak hands and some of them can be strong hands with high conviction. I'm wondering whether you've seen anything on chain to indicate that from an institution point of view, whether, the ones coming in now are weak hands or strong hands, or do you think it's more like we won't know until they get tested? So let's say, I don't know, just for example's sake, let's say it goes to like 250,000 and then it crashes to, 50,000 or 100,000. are we only going to know at that point how many of them are strong hands?
Yeah, I think so. I think it's a bit early, especially from an on-chain perspective, because I don't think that, institutionals with all the overheads that they need in order to come into the space to actually, invest. I mean, those are processes and preparations that, as far as I know, I don't have deep insights, but they take a couple of months, right, in order to be able to execute to the amount that they want. And so I believe that it's a bit early yet to actually get a feel for their conviction and whether they're here for the long haul, or whether there's among them actively managed funds that are essentially trying to just maximize the profits and get out as soon as possible. Again, I don't believe that's the case, especially if you look at the names of companies that have announced their investments. That to me sounds more like we're here to stay for at least for a good while.
Yeah, and it's fascinating because I think the narrative has really shifted in the last year or so, where there's really much more of a long-term store of value conversation. So potentially that would lead people to be stronger hands, even coming into it, rather than kind of historically where people had to go through a cycle to become a strong hand. But then on the counter side, you might see the more professional level investors and institutions who are trying to rebalance on the way up, where typically a lot of individuals don't bother rebalancing on the way up.
Yeah, and probably make use of the volatility as well, right? That you don't get anywhere else. So yeah, I think we still have to wait and see what this does. It's something that I'm very curious about, because it's Bitcoin up to now has moved very mechanically, right? Has moved very predictable. I mean, it's insane if you look at these market cycles, right? How beautifully they just come and go, and now you have this new stream of investors that have potentially different conviction, potentially like different ways of behaving in this market, like what this potentially does structurally to the space. I'm super curious to see how this plays out. And if whether all those quote unquote predictions and models that people have play out, or whether they kind of get disrupted by this new mature money that has flown in. Yeah, I'm really curious to see that.
Yeah. Also, the other interesting topic I wanted to discuss with you, and I know you've done some analytics and data science work on this too, is concentration of ownership. Now, there's this kind of often quoted sort of mainstream media argument of 2% of accounts, which first of all, that's wrong. 2% of accounts control 95% of all Bitcoin. Is that true or is that wrong?
Yeah, no, that's obviously wrong, and I think some of the analysis that we did was essentially to debunk that, right? And that number, these 2% of accounts control 95% of all Bitcoin, is something that has been popping up all the time. I mean, the sentence itself is wrong, because what do you mean accounts? There's no accounts. So right, it's first of all, if you're talking about addresses, then that's a different story. But so the whole thing about this is that if you look at the blockchain and you naively do this computation, right, and you take all the addresses that exist, and you look at all the Bitcoins that all of these addresses hold, then you arrive to exactly those numbers, right? In that sense, they could be correct, right? 2% of the addresses are holding 95% of Bitcoin. But of course, if you're doing these analyses, you need to be much more nuanced, because this just leads to these very, very wrong narratives that are, are then being picked up by the media, and this is, what stays in people's heads. And so what we did is we tried to get down to something that comes closer to the truth than this, right? And I think one of the important things is that not each address on the blockchain is to be treated equally when you do these kinds of analysis, right? Because we all know, if you have an exchange address that holds the funds of millions, of hundreds of thousands of or millions of users, then that's very, very different from, my hardware wallet address, right? And so, or look at miners is the same thing, and so on and so forth, right? So there's these distinctions that you need to do on the one hand, all right? And then also, when we get back to clustering and then heuristics and so on, of course, I can have multiple addresses that are all controlled by me, right? So these should not, if there's possibilities to assess whether they are controlled by the same participant, we can make use of that information as well. I mean, so that's essentially what we did, right? And of course, our methods are not perfect. We're talking again here about statistics and heuristics and clustering and address labels, and it's not 100% correct, but you immediately see that you're shifting that number that shows that high concentration way further down, right? So 2% do not control 95. Our upper bound is essentially the 2% might control 70% or so, and that's what I mentioned, that is an upper bound. So we are very, very conservative there with the methodology that we apply, right? If we are not sure that something is actually should be clustered, then we're not doing it, and we believe that number is way less, especially if you take into account numbers that you cannot get from on-chain data, which is the amount of users on an exchange, right? I don't know, like the exchange on-chain is essentially, well, a black box, right? It's just a set of addresses that hold funds, and then they have their own accounting on top of it, but that's something that we cannot see. And so this whole analysis was in order to debunk this statement that was popping up all over the place.
Yeah, I see. And in your analysis, you actually categorize, or I guess stratify, the different holding levels. So you say, as an example, shrimp with less than 1 Bitcoin, crab with 1 to 10, all going up to, fish with 50 to 100, and then, sharks with 500 to 1,000, whales with 1,000 plus coins, and then humpbacks 5K and over, the Michael Saylors of the world. And then you got like exchanges as well. So that's a really interesting analysis. And I guess it gives some rough level of what size holders there are on chain. That is obviously not talking about people who leave their coins on an exchange or with, I guess, some large custodian.
Yeah, absolutely. Yeah, I think that categorization comes, was initially in some very early forum as well, and then I got into a conversation with Willy Woo. Actually, we talked about this, and this is, and then when we then decided, let's do this analysis, and let's categorize all these different players, these participant sizes, into these different maritime fauna, and put it out there. So just as an educational piece to show that it's not as bad as people try to paint this. So yeah.
Yeah, and also interestingly, I thought it was fascinating that you were saying the amount of Bitcoin supply held by the smaller groups, the shrimp and crab, has actually increased, and that some large entities, so dolphins, sharks, whales, and humpbacks, so we're talking, what is that, like, which one's dolphins again? Sorry. Dolphins are 100 plus. So basically, the amount being held by those dolphins through to the whales has actually decreased a little bit. And also, you mentioned that there have been new whales birthed, in a sense. Could you explain what that means?
Yeah. So essentially there's two different insights here, roughly. So over time, over the years, what we see from this data is that Bitcoin gets more dispersed, right, from larger entities into these smaller ones, right, which is a beautiful thing to see, because that sort of like ties into this ethos of decentralization and again, like, against Bitcoin is highly concentrated. No, it's actually spreading over time. That's one of the trends that we saw in the data. But then interestingly, on a more short term, and that is throughout 2020 and 2021, what we saw is that the supply, or the amount of whales, has risen a lot, right? Again, you can make the connection to institutionals, the connection to the depletion of liquidity on exchanges, and so on and so forth, right? So very, very nicely to put all those data points then together to actually see, oh yeah, these are related to these big players that have been entering the space. And so we've seen this rise in whales, and we framed it as the whale birthing, because it's the amount of entities that hold more than 1,000 Bitcoin, and that has, I think in December and January, it just surged a lot. It has come down a bit now over the last couple of, 2-3 weeks, but we really saw that huge increase throughout the last couple of months on chain.
Yeah, this is all very fascinating stuff. So I guess maybe if you were to, have your outlook over let's say for the rest of this year, what are some of the indicators? What are some of the things that you are looking out for?
So I think there's in general there's a couple of themes that I look at. So one thing that I never take my eyes off is network activity, network health, network security, right? These fundamentals. I want to know what is happening there, and what is the hash rate doing? What is the amount of activity in the network? Is it healthy? What is the adoption? How many people, new users are coming in? That's something that I look at very, very closely. Then I think this whole liquidity narrative is something that I'm keeping my eyes on very, very closely, and to see actually how that plays out, how that structurally maybe changes over the next weeks or months, or whether that trend actually continues. I'm looking at whales as well. So these larger players, whether there's more of them coming in, whether we can gawk, if they're transacting, then really make the connection again there to off-chain data, to something like what are the Grayscale holdings, what is the Bitcoin ETF doing, right? So everything that goes into the direction of institutionals and the data points that are available for those. Right now, I have a very close eye on retail. I really want to see, how this plays out, if this keeps uptrending, if we can actually see a lot of FOMO and FUD within this bull run, potentially a bit more volatility, whether we really see increased activity of transactions into and out of exchanges. That's definitely something that I look at. And then I think really these market indicators, right? These market cycle indicators, like we talked about Nupal. There is things like SOPR, the reserve risk, the MVRVZ. A lot of these fundamental cycle indicators that give you a good sense of, which of those indicate that you might be getting into the danger zone of, reaching a top. And then I think what will be really interesting to see is, whether this is potentially a double top cycle, where we get up to whatever, 80, 90, 100, have a big correction and then start ramping up again. That's something that I'm looking at as well. And something we didn't talk about, which is off chain, is the derivative space, right? I think futures and the open interest there is something that I really like to look at a lot with respect to, and then also combine it with on chain, because derivatives are something that have gain a lot of traction. In fact, there have been now times where they showed more volume than spot exchanges, and so and at the same time, it also means that if you have these futures contracts, that there is margin locked up in these contracts that then again ties into the whole kind of supply and liquidity narrative. So I would say roughly those are the big things that I'm looking at, and probably I forgot many.
There's so many
because it's just so there's so many and so much that is interesting there.
Yeah, well, it's been really fascinating. I just there's a lot of insights to be gleaned from this as well. So, Rafael, before we let you go, where can listeners follow you, and where can they find Glassnode online?
Yeah, so on Twitter, it's glassnode.com for the company. I'm Neocortex on Twitter. First E is 3, and otherwise on studio.glassnode.com. This is our suite where we have all the metrics that we talked about here today as a live version for people to explore.
Excellent. Well, look forward to chatting again soon. Thanks, Rafael.
Thank you very much, Stefan. It was a pleasure.
So let me know what you think of the discussion about on-chain analytics with Rafael there. My DMs are open on Twitter. You can find me at Stefan Livera, and my website is stefanlivera.com/258 for the show notes on this episode. Thanks, and I will see you in the Citadels.